I'm Ryan Lightfoot-Brown of Chelsea Financial Services. We're joined today by Bertie Thomson, manager of the Brown Advisory Global Leaders Fund. Thank you very much for joining us.
Thank you for having me.
Now, your process has sort of four stages. There's the valuation and the return on capital, sort of the numbers side of things, but also you've got the product has to be good, the product or service, and the management team as well. I was wondering if we could sort of go through each of those and sort of look at the funds in the process.
Sure, absolutely. So any investment in global leaders has to satisfy each one of our core key tests, which are essentially the test that any potential investment needs to pass through. The first is really the franchise quality. We're looking for companies that do something very special for their customer, and they need to also have their business surrounded by what we call economic moats. These are essentially forces that will insulate the business from competition. The second test is what we call quantitative metrics, and really this is that we have to see the quality characteristics of these companies in the numbers, which, as you mentioned, is return on capital, and it's also free cash flow, because free cash flow for us is the core conception of value. The third of the four tests is management quality, and we're really looking for managers that we feel have an investor mindset. This is incredibly rare amongst CEOs and CFOs who've come up through organizations. They have to think like investors when they allocate balance sheet and cash flow. And lastly, the last of the four tests is valuation. We have to buy these great companies when they're undervalued, because at the end of the day, this isn't just an academic exercise. We're here to make money for our clients.
Just going back to the first of these, identifying these companies, the product or service you're looking for is meant to deliver a superior client outcome, as you say in your literature. Can you explain what you mean by that, and perhaps maybe put a couple of examples on that?
Yeah, absolutely. It always kind of mystifies us how little attention investors give to the customer. Really, value for any company starts with the customer. And you can see in any financial statement, whether you're looking at a profit and loss account, cash flow statement, or balance sheet. And to be very trite about it, if you don't have a customer, you don't have a business. So what we're looking for, as we say, is companies that do something special for the customer. That means that the customer comes back time and time again to consume those products. A good example of this is the relationship that both of the payment networks that we invest in, Visa and Mastercard, have with the issuing banks that they work for, and also with the merchants around the world. You take a company like Visa, there's 61 million merchant locations in the world, 3.4 billion Visa cards out there, and they can instantaneously guarantee your payment with your bank in a split second. That is a very, very safe and secure network. It benefits the ecosystems of customers that bank and use Visa. It also benefits the financial institutions that issue the cards. And lastly, it also benefits the merchants, because they know they're going to get paid when you go into a shop and use your Visa card.
And one of the other stages, and it's the third stage, that was management quality. Can you perhaps talk us through that as well? Because you look at the history of the ethics and the long-term vision of these companies, and maybe put a bit of colour on the example you used before, like Visa, with that.
Yeah, no, absolutely. The thing about management quality, it's not the most unique characteristics that we look for. I doubt that you meet many investment managers who say that they really target bad quality managers when they look for an investment. But when we look at management quality, we kind of define it differently. As I mentioned earlier, we're really looking for companies that have a management team that have an investor mindset. So they think like investors. So when they deploy balance sheet and capital, they're thinking very much about the long-term value generating aspects of that deployment of balance sheet and capital. And I think Visa has that in spades. Not only do they have a great network around the world, and so does Mastercard, the company is investing in next generation technology. Something such as Visa Connect would be a great example of that, where essentially they are putting money behind next generation business to business technology that will benefit the business and will benefit the customers in a totally different sector for many years to come.
And while these are great companies with good management teams, one of the most important things, which I think you touched on at the beginning, is the valuation of these companies. What's sort of your unique ability in valuing these companies?
Yeah, I think valuation can be approached many different ways. The core way that we analyse any company is using cash flow. At the end of the day, cash is what comes out of a business. We often joke on the team that you can't pay dividends with earnings, you can't pay down debt with earnings, you can't buy other companies with earnings. We value every company with cash flow because you can do all those things with free cash flow. And for us, it is the core conception of value. We have a standard cash flow analysis framework that we use. We use a cost of capital that we think is quite conservative, and our valuation discipline takes us to places where certain other quality focused managers don't go to, and also at the same time it keeps us out of areas that many quality other focused managers aggressively go to. So a good example would be we're underweight healthcare at the moment. Not that we don't like the quality characteristics of a number of medtech companies out there, it's just that when we run a cash flow analysis, we think that these assets are very, very expensive on a through-cycle basis, and we choose not to participate because, as I mentioned earlier, we're really here to make money for our clients rather than just making ourselves feel good about buying great businesses.
And one really interesting, quite intriguing part of your process is you use a third-party business to go and analyse your team's decision making, or make sure you're not making any behavioural finance errors. Could you perhaps talk about how you use this, an example of how it has improved your process?
Yeah, absolutely. We really believe that human beings are uniquely disadvantaged for this activity. In many ways, we're doing a 400-year-old job with a 2 million-year-old brain. Many of our behaviours are really being fashioned through evolution, which were very helpful when we were living in caves or in the savannah, but they're not very helpful when you're allocating capital. One of the best examples of this is we are hardwired to survive, and we really avoid pain at all costs. And investment, this means that we don't like dealing with losers, essentially. We don't like facing up to losers because losers are a source of pain, which means that it's very, very easy for a small loser to end up becoming a huge loser and destroy a lot of value. So we work with some third-party consultants to help us become better capital allocators and try and iron out some of these behavioural issues. And in the loser example, which specifically is around a behavioural bias called loss aversion, we have a drawdown rule where we automatically review an investment that has underperformed by 20% since we bought it, or by 20% on a rolling 12-month basis. And at the end of that re-underwriting review, we're doing one of two things. We're either buying more or we're selling, because to do nothing is essentially loss aversion. And when you look at the data, more often than not, when we've bought on the back of the drawdown review, that has added value. And more importantly, when we've sold on the back of the drawdown review, that has preserved our clients' capital. So as we continue to work with these consultants, we expect to bring in more and more rules that help us become better capital allocators and limit the damaging impact of human behaviour on our clients' capital.
Okay, and moving on to sort of the bigger picture, we've seen a bit of a trend against globalisation with sort of the trade wars and things like that. Do you worry that the outlook for your global leaders companies has been diminished and that they can stay global leaders in the future?
Yes, we do. I mean, we are incredibly paranoid about the competitive position that our companies have in their marketplace and the number of economic moats they have the business model, because essentially this is what is going to insulate these businesses from competitive forces, which is actually one of the major risks that we face with our investment approach, essentially that a competitor will enter the marketplace and try and disrupt the relationship that the company has with its customer. So we are very, very paranoid about that. We're also looking for companies that we feel are good corporate citizens. They do something special for their customer, but also they engage with local regulatory bodies, they engage with local governments, and are actually doing good in the world. So when we look at the companies that we invest in, yes, trade wars might come and go, but we do feel that the companies that we invest in have a very, very attractive long-term future ahead of them.
Bertie, that's been really interesting. Thank you very much for joining us.
Thank you for having me.
And for more information on the Brown Advisory Global Leaders Fund, please visit chelseafs.co.uk.